Welcome to The Big Break Show, a podcast where we discuss short-term rentals, entrepreneurship, life, mindset, and everything in between. Here are your hosts, Rafa Loza and Jesse Vasquez.
What's up, everybody? We are back with another episode of The Big Break Show. And man, do we have a good one for you today. I'm sitting here with Mr. Jesse Vasquez. You want to tell him about it, buddy?
Yes, I do want to tell you about it. So if you guys are looking to either get started in real estate or you've already owned multiple different properties, this episode is going to be good for you because Jeff goes into super freaking detail. In detail, he talks about the feds. He talks about like different rate hikes, why they originated, where they came from, the shortage of housing, just all the kind of combination, Rafa, that we see happening right now. And when this comes out, it'll probably be late October. But man, there's just a lot of intelligent conversation that Jeff's just a smart dude when it comes to mortgage. He's been around for a while. Rafa's lender.
Yeah, I work with them now. He's doing all my stuff. So, I don't want to go into the details. The best way to put it is he helps investors scale their real estate portfolio. And you're going to know why once you're done with this episode, because he just goes into serious detail about serious options to make pretty much anything work. So without further ado, Mr. Jeff Welgan. Hey guys, Rafa here. A lot of you guys have been asking me if I have a course, if I teach, if I mentor my short-term rental business. And the answer is I do, actually. I just recently released my very first course. It has about 120 videos. If you're part of the monthly membership, we are adding 2 new videos a month in current issues or projects that I'm working on within the short-term rental business. And we do 1 monthly call live where you have access to me to ask me all the questions you want. So if you're interested in joining the course or if you want any more info, click the link below. It is application only. We only open it to a certain amount of students every month because we want people who are serious, who really want to be a part of this, who actually want to take their short-term rental business and grow it, or are starting from scratch and want to learn how to actually acquire properties doing rental arbitrage. If that's you, if you're serious and you really want to do this, click the link below, schedule a call with me or my team, and we'll get you going. Now back to the show. Jeff, what's up, brother? I'm so glad you're on the show, man. I know we have a ton of questions for you, especially with the current market conditions and everything that's happening. Before we get into our questions, and I know Jesse has a ton of mortgage stuff he wants to talk about, I want you to tell the listeners about who you are, what you do, and what's your expertise, and we'll go from there, man.
That sounds good. Well, thanks for the invite, guys. I'm looking forward to this. My name is Jeff Welgan. I'm with Bluprint Home Loans, and I'm an investor strategist. I've been in the mortgage industry for the last 19 years on the financing side. And I started out as a loan officer, working with a lot, basically anybody under the sun. We were doing first-time homebuyers all the way to real estate investors. And I've really moved into, over the last 10 years, the niche of real estate investors. I grew up in an investor family. My dad was a real estate investor. I grew up around it. Learned a lot from him. And, 25 years ago, to date myself and how old I am, my early 40s, I tried to get off into real estate investing on my own, because I really didn't want my dad's help. And I didn't, I was young, dumb, didn't want to learn from his mistakes. And early on, I called around to a bunch of realtors and called a bunch of different mortgage companies. I called 8-10 different mortgage companies and was trying to figure out the ins and outs of mortgage lending and try to figure out how I could get my start back then. And I came out of it more confused than when I went into it. I mean, I got conflicting stories, all this misinformation, and I saw the opportunity back then, but I wasn't, in a position to do anything about it. So fast forward, I got into the mortgage industry after college and have just naturally gravitated toward this space because of my upbringing and, what my experience with this. And one of the things I always like to ask, when I'm giving presentations or I'm on podcasts like this, you guys have both owned real estate, at this point. The last time you took out a loan, did you love the loan process? What was your experience?
If it wasn't for you, I'd still be confused.
Yeah. It's the response that I normally get, unfortunately, because it is a very challenging part of my industry. When it comes to mortgage lending for real estate investors, it's the most difficult thing you can do in my side of my, in my industry because of the complexities and the difficulties of working with real estate investors. And so what we've really strived to do here is break down the barriers for real estate investors and simplify the process. And I specialize specifically in helping my clients build and scale their real estate businesses.
So, you know what? I'm glad that you brought up how confusing the process can be. And this is one of the reasons why I was excited to have you on, because even for me, like I haven't bought that many properties, right? And usually when I do, other people get involved, or we do like syndication style, or a lot of the stuff that I do is arbitrage stuff. So I always have somebody else that kind of does the work for me. And I'm kind of in the background just saying yes, no, whatever you think is best. And I've never actually been involved in it because it's super confusing to me. There's like loan officers, mortgage office, like I don't know what's like all the official titles. And then on top of it, it's like this whole, like, even for the current loan that we're going through right now, Jeff, it's like a big puzzle that you're putting together. So can you touch a little bit from like a very beginner standpoint on like what it's going to look like for someone who's going to buy their very first house and what they're going to have to go through and how they can make that a lot easier for themselves by working with the right person, or what you recommend?
Yeah, absolutely. And this is part of what we do. So we work from anybody from a first-time home buyer that's investor curious, that's thinking about, how they can get into real estate investing, all the way up to seasoned real estate investors with, hundreds or thousands of doors. It's important leading into this that investors or anybody that's wanting to get into this space to understand the shift that we've gone through here over the last year and a half. We're going through a period very similar to during the Clinton administration in the mid 90s up until the mid 2000s, where the big push was to get as many first-time home buyers and low to moderate income families into homes. And what the Biden administration has really done is try to slow down real estate investors. And we'll get to this here in a little bit. They've made investment financing much more expensive and complicated than it has been, over the past 18, 19 years. But from a first-time homebuyer standpoint, if you haven't owned a home in the last 3 years, you qualify for first-time homebuyer financing. And it hasn't been this easy in 15, 20 years to come in and buy a house with no money down, because we can do nationwide 101.5% financing. Basically, what that means is 100% financing, 100% of the purchase price plus 1.5% of the closing costs. And then in some states, we can go up to 105% financing, where we can do 100% of the purchase price and 5% of the closing costs. So what that basically means is that you can come in. We have clients in certain parts of the country that are coming in and buying a house for less than $1,000 right now.
Okay, I have a ton of questions. Hold on a second, because aren't people buying houses less right now, right? Than you, what is it, Gen Z, Gen X? Where are we at now with the younger gen?
Yeah, Gen Z.
Yeah, aren't they buying, like, isn't there a statistic where they're buying less houses because they want to travel and rent and live at different places?
Absolutely. It's the younger millennials that are really moving into this space right now. But the bigger problem is there's no inventory. I mean, we have a shortage of about 3 to 5 million homes out there right now. So even with all of this down payment assistance money and government money, we still have the same supply and demand issue that we've been experiencing over the last 5 years. And that's what's been leading to real estate values continuing to go up and why the market hasn't crashed. I mean, there's been so much misinformation surrounding that. But you look back at the birth rate during the late 80s and early 90s, we had a birth spike back then, a birth rate spike. All of those young adults are coming of age. They all need somewhere to live. And that's what's caused this huge supply and demand imbalance, because in 2008, when we went through the Great Recession, it was caused by our industry and builders overbuilding. We were doing bad loans. The builders built way too many loans because all the speculation that was going on leading up to it. We've learned our lesson and they learned their lesson and they stopped building. And so that's why we have such a imbalance right now, because we've got about a 5-year backlog at this time. If builders were to start building full bore, probably 3 to 5 years if they were to try to build our way out of this using stick-built homes. And that's why we're starting to see more creative options like modular homes, manufactured homes. There's these SIP-built homes now that are they bring them in pieces. And so that we're starting to see more and more activity on that side, and lending open up to those types of homes as well.
Okay, and so hold on, Jesse, because I have a few follow-up questions if you don't mind.
Oh, yeah, I do mind, actually.
Oh, sorry. All right, go ahead, buddy.
Okay, I'm in no rush. So
no, okay. So it's because the last recording I cut him off for like a solid hour.
I didn't even talk for 45 minutes last recording. So go ahead, Rafa. This is Rafa's show now. Go ahead, buddy. I'll just sit
All
here.
right, sorry. No, I promise you'll get the entire second half. All right. So okay. So Jeff, really quick, going back to the low down payment, right? With $1,000 home. Isn't that going to wreck them on the monthly payments with the high interest rates and like the high cost of the houses?
That's part of the problem right now, is that, with rates going up as quickly as they have, very few first-time home buyers are able to take advantage of this right now, especially where we live, near the coast. I mean, good luck. In the Midwest, we are doing a lot of these. I mean, we have branches all over the U.S., and there are certain parts of the country where we just opened up a branch up in Idaho, and they do a ton of these up there. They're a part of our builder division, and that's what they specialize in. And they literally have, their borrowers or clients that are coming in and buying homes for $500 to $1,000. So it just depends on where you are and how much inventory is available, and ultimately how affordable the homes are. Because in Southern California, you just can't get these to work. But you start going to Arizona or start heading back east, there's plenty of markets where we're doing, many of these.
Got it. Okay.
Oh, now am I able to ask a question now, Rafa?
Go ahead, Jesse. I'm going to stay quiet, bro. I don't want you yelling at me later.
Well, I had a couple of things on I wanted to ask you about the lack of housing right now. Do you see that changing at all, Jeff? Like, do you see, because I see builders that are starting to build in my market. Like, I'm in Northern California. There's new subdivisions popping up all over the place. The houses that are being built right now are pretty freaking expensive, like based off of what's being sold. It's older homes. So they're a lot more expensive than older homes that are the same square footage, which is kind of odd. So, but then those builders are also giving a 5% rate or a 5.5% rate.
Yeah.
So they're actually buying points to get that house down to sell the property. So are you seeing that right now?
Yeah, it's called the forward lock. So what the builder is doing is buying a block of money. They forecast how many properties, homes they're going to have come to market, and they're going to buy a block, and they lock in a chunk of money at a certain rate, and they pay that buy down to get the rate from, let's just say rates are at 7.5 right now. They pay the cost to buy that block down to, let's say 5.5, and then they have to deliver by a certain point. So those homes need to come to market. They do need to make that lock commitment, but that's the way that the builders are doing that, and then they obviously build that cost into the cost of the house when they're selling it to the home buyer.
Got you. So do you typically see those? Is that why these houses are costing more? Like they're more expensive because that?
I mean, it's a combination of things, but yes, that's part of it. Supply and demand. They know they can sell them for more right now because there are so many people that are stuck on the sidelines right now just because there's no inventory, or they're watching too much news and they think the market's still going to crash, or they've been priced out because of interest rates. I mean, that's been the big shift with rates going up as quickly as they have over the last year and a half. You got to think about all the pre-approved buyers that we had, in the 2 to 4% range, let's call it. When rates jumped up to 7%, a good chunk of them, probably 70% of them, could no longer qualify. But what we saw happen earlier this year is when rates dipped back down to 6%, buyers that could qualify jumped back into the market. Mortgage applications were up, and property values started turning around, going the right way again. And so that's why, we're coming to the end of this financial cycle. When it's going to turn is, it's like throwing a dart at a board at the moment. My feeling is we'll probably start seeing some relief in Q1, Q2 of next year, unless something really changes between now and then. If something breaks, or, we start seeing bigger issues with the banking industry, kind of like we saw with the regionals. But for now, I mean, the Fed has really come out with at their latest meeting. It was, a couple of weeks ago. It's October 4th right now. And made it very clear that they're going to keep rates higher for longer. And Wall Street has finally come to terms with that. And as a result, we've seen rates jump up about 0.5 point here in the last week and a half as a result of this, because there's been this narrative this entire year. And there's been so much conflicting guidance and forecasting since the end of last year. Wall Street was convinced that we were going to see rates back down in the 5% range by the end of this year. And the Fed the entire year was saying, no, we're not going to. We're going to keep them higher. And now we finally collectively as an industry and as on the finance side and Wall Street have realized that this is not going away anytime soon. This is where rates are going to be for the foreseeable future, unfortunately, until we see a couple of things. Inflation continue to come down quicker. Unfortunately, it's been coming down a lot slower than we'd all like. And for the employment market, jobs market to really start cooling off, because we haven't really seen any meaningful gains on that side. All the jobs numbers that keep coming out have been pretty hot up to this point. We've got another number coming out on Friday, and we'll see what happens there. But I think going into Q4 this year, we're going to see rates at these levels. They may even go a little bit higher depending on what the Fed decides to do. But the part of this that gets less coverage, and I'm sure you guys have heard this, they're really trying not to make the same mistake as the 70s and the 80s. Looking back to that period, last time when we had inflation like this, the Fed at that time reversed monetary policy too quickly. At the first sign of inflation easing, they took their foot off the gas, they lowered the Fed funds rate, and that's when inflation skyrocketed and became sticky. I mean, it gets ingrained into our psyche. All of our decisions as consumers are based around where inflation is going to be, what's the cost of everything going to be. And they had to destroy the economy back in the 80s, the early 80s, late 70s, early 80s, in order to really squash inflation. And so this time around, the Fed is trying not to make the same mistake twice. That's why they're keeping rates higher for longer. And we'll see if they hit this elusive soft landing that they keep talking about. But if it's anything close to a soft landing, we're going to see elevated rates for a longer period of time.
What's your estimation in terms of a longer period of time that based off your expertise?
This is the $1 million question. And I've been burned on this once or twice this year. So I tend to take a little bit more of a conservative approach. Back when Fannie and Freddie and Wall Street was saying somewhere in the 4s to 5s. I was thinking maybe somewhere by around 6 by the end of the year. We're pushing 8 now, and there is little to no relief in sight. So as far as throwing a dart at the board estimate at this point, because everybody wants to know the exact day and time of when rates are going to start coming down, my guess will be by the end of Q1, maybe early Q2, because we've got an election year coming up, and I don't touch politics. You'll never see me, talking anything about politics other than this. I mean, we have an election that's about a year away, year and change. And in my mind, there is little to no way the Democrats are staying in office if it's anything like this right now. So my feeling is there's going to be a lot of political pressure the early part of next year to start reversing monetary policy to stimulate the economy, which is going to mean lower rates. The other variable or unknown variable, if the Fed hits the soft landing, we'll probably see rates stay more elevated in the mid 6s. But if we do start hitting a recession, recessions are very good for interest rates and even better for real estate historically. So looking back, I mean, at a historical chart, with the exception of the Great Recession, typically real estate values go up, interest rates come down. And when we hit that point again, where we start seeing rates coming somewhere into the, let's call it mid 5s to low 6s, that's the inflection point that we see on the horizon, where the majority of these home buyers that were stuck on the sidelines that can't qualify will be able to qualify again, jump back into the market, which just leads to higher appreciation in home values in the future.
Yeah, and a lot of these things too are just projections. Like, we can't tell the future. I don't think we've been in this spot before ever. First off, there was always a lot of homes being built. Just between 2010 and 2020, that decade, I don't remember what the statistic was, but it was like 7 to 10 million homes weren't built during that time. Yep. And every decade before that, there was literally like 3 to 5 million homes built. So we're already in a deficiency. There's more people on Earth, and more people in the U.S. So we're in a weird spot, man. It's a weird, a different time. But yeah, I agree with you. Like, I'm not big on politics. I'm not, but I also have to look at things and be like, we got to see what's going on right here, right? We have to see
what's macro happening. Level, and understand.
Yeah, like we have to see what's happening in a different idea, or the different market. And I think, I hope that things go down during the election year. I mean, we'll see. But you never know what can happen. There could be a war or something that goes off. We never know, right? And that can change things dramatically too.
Black swan events. I mean, that's the wild card. You never know. I mean, it could happen tomorrow. And we know a recession is coming at some point, because there's always going to be a next one. And whether it's next month or 5 years from now, I mean, it is coming. It's just being in a position to capitalize on them when they do occur.
Yeah, I totally agree.
So I don't want to shift the conversation, because I like the direction it's going. But something that I did want to ask you, Jeff, that you said at the beginning, is that you help investors scale their real estate portfolio. And I want to ask how you do that, and if you can touch on that.
Yeah, absolutely. You start from the perspective always of trying to help our clients, build and scale their businesses as efficiently as possible. And we always look at it through the lens of trying to maximize our clients' cash flow and cash on cash return. And so basically what that means is, and really one of the differentiating factors with us versus a lot of our competition in this space, is we have all the conventional licensing as well as being able to do all the non-conventional stuff and all of the fix and flip, hard money, construction. We have outlets for all of that. I specifically am an expert and focused primarily on 1 to 4 units residential, but I have friends, that I've been in the industry with that are on the commercial side. They've been doing it as long as me. So if anybody has commercial questions, reach out and I can, connect with a couple of my friends. But back to the original question. So what we will do, and this is one of our value propositions, we'll sit down and do 5-year planning with our clients, where we will sit down, have the initial consultation, figure out where you see things going, and really connect the dots and work backwards. And so we have some clients that want to, build a business up to 100 doors. We got to figure out how to get there. We lay out that blueprint or that roadmap and show them how to get there. And then we do a lot of loan and tax planning. Full disclosure, I'm not an accountant. I cannot give specific accounting advice. I have to say that. But what we can do through this planning process is work backwards based off of our clients' goals and figure out, okay, based off of, let's say, the next year to 2 years, because that's the shortest window and where it's most critical. What's the end goal? It's always good to have the goal in mind when we're going into the planning phase, and then work backwards and put together that plan and show you how much you'll need to put down on each property, how much income and depreciation will need to be documented, and give a little bit of a range on that as well. And then that way we really try to connect those dots to simplify that process, to provide clarity for our clients, because that's always been one of the biggest complaints I had early on and that I've heard over the years from all of my investor clients is, most lenders are looking at this from a very transactional standpoint, where it's just get the deal done, move on to the next one. We take an advisor approach. So I'm a certified mortgage advisor. I've gone through training for this, extensive, I have years of experience, over a decade of experience working with investors, where I've figured out the boundaries of what is legal and what is sellable on the secondary market. And that's how we help our clients and really advise our clients, because there's so much misinformation in the investor space where, we can get into a lot of the details and you guys can ask me what questions that you have specifically. But for instance, just starting from what we were talking about earlier, from a first-time home buyer or an investor curious standpoint, when you're buying that first house, you can come in and do 101 or 105% financing, like we mentioned. And then what investors will typically do is buy their next primary residence a year later. Outside of a year, we don't ask any questions. The rule is, as long as when you buy a primary, you have to be in it within 60 days. You have to live in it for a year, and then you can buy another one. I have some clients that have bought 6, 7, 8 primary residences over the last, 10 plus years. Personally, I don't ever want to move that much. But for people that have that flexibility and the ability to do it, there's no restrictions on that side. You can't continue to do down payment assistance every time. You can only do that the first time. But, door number 2, 3, you can do anywhere between 3.5% and 5% down. And so this is the way investors scale when they're just starting out and don't have a lot of money. It's a much slower approach to scaling. But as you buy each property, the home that you lived in for a year, we turn that into a rental property. We can use the rental income to help you qualify for the next one. It can be a short, mid, or long-term rental. So there's flexibility there as well. And then where we go from there typically is look at the next 2 programs, with the 10 and the 15% down options. 10% down loan is in a vacation home loan. It is not an investment property loan. So with this program, and I know you guys have used it, I'm sure you've heard a lot about it. With this, we look at it from the perspective of, you have to use it for personal use for some portion of the year. It's not 2 weeks. 2 weeks is an IRS rule. It's not a lending rule. In the guidelines specifically, it states you have to use it for some portion of the year. We recommend 2 to 4 weeks to our clients, just so that way you're allocating enough time for personal use. And then there's no restriction after that on how long you can rent it. So with Fannie Mae, it's literally that vague, some portion of the year, no restriction on maximum fair market rental days. With Freddie Mac, on the other hand, it's a max of 180 days. So if you've ever heard that, that's where that came from. So we naturally sell all these to Fannie Mae because they're more investor friendly. And then the other restrictions, we can't do any type of joint ventures with these. It has to be owner operated. You can't relinquish management control, no timeshare agreements. And the biggie is we can't use any rental income to help you qualify because it is a personal use loan. So it has a full hit to your debt to income ratio compared to the next option, which is the 15% down option. By putting the extra 5% down, it turns into a true investment property loan where it takes all those second home loan guidelines out of the equation, and we can use the rent to help you qualify. And so it has a much smaller impact to your debt to income ratio. And to put it in perspective, most of our clients can qualify for every 1 second home loan. They typically can qualify for 2 or 3 investment, 15% down investment property loans with the same debt to income ratio hit. So those are the preferred methods when you're starting out and have relatively limited capital. And then as our clients build their business and start, getting some cash flow going and start saving some money, then we can start looking at other alternatives. But with these 3 specifically, we can do up to 10 finance properties. And I get this question all the time for couples, whether you're married or not. It's 10 financed each as long as you can qualify on your own. So a married couple theoretically could do, 20 finance properties. But there is a tax consideration with this that doesn't get much airtime. As you start to scale, you got to think every time that you're building, you end up buying another property, you have to document more income, and everybody hits a point typically with their income and how much they're going to end up having to give the IRS at the end of the year, where it makes more sense, usually somewhere between properties 5 and 8, where we will switch to one of the other alternative financing options like the DSCR. You can figure if you got to document an extra, $50K in income and give the IRS an additional $20,000 just to qualify for that next property or two, it makes more sense to take that money, don't give it to the government, and use one of the other alternatives where we're not looking at your debt to income ratio.
Okay, so there's a lot there. And I know we're going through it right now, so I'm kind of glad you're bringing this up. Okay, for the vacation home loan, what's the tax benefits to having that vacation home loan?
As far as tax benefits are concerned, you can still do cost segs on these, is my understanding. I defer to the experts when it comes to any kind of accounting advice, cost segregation advice. I'm not a cost seg specialist. Plenty of clients like yourself that have done them. I understand how they work, but I don't know the exact implications as far as what the IRS is going to allow or not. From our perspective, we can use all of that depreciation and add it back as income. So, the big benefit there obviously is that, for our clients that are, making a lot of money through their W-2 jobs or through their businesses, we can use that depreciation to actually offset any capital gains or any tax liability. It's like one of the things that we have. I have one client here this year that sold a business and had a huge capital gains liability tax at the end of the year. So what he did is bought 3 short-term rentals, did cost segs on all of them to minimize it, and brought his taxes down to 0. So that's one of the benefits. It is, from my understanding, allowable on second home loans. I see them all the time. I can't say with certainty that the IRS is going to sign off on that, but hey, that's for the tax specialists and the cost seg specialists to clarify. But from any other tax benefit standpoint, you can obviously write off your interest expense, the taxes, that kind of stuff, just like you do on your primary residence.
Okay, and the benefit is also lower down payment, right? What about mortgage insurance?
So with the mortgage insurance, it's less on the 10% down than it is on the 15. And there's actually non-conventional options that have no mortgage insurance at 10 and 15% down, a little bit higher interest rates, but because there's no mortgage insurance, the payment difference is typically nominal. It's not not as significant as you would expect. The caveat to it is, though, it requires a higher credit score with these non-conventional options. So we've got the conventional route where we can go down to a 660 credit score on a 10% down and 680 on the 15. But the non-conventional, they require a minimum of 740 right now.
Got it.
Got you. Yeah, man, that's a lot going on. So like what do you guys have that is available for, once people start scaling, after the 10 properties? One thing that's always been, and Rafa and I always talked about this on here, like putting as least amount of money down as possible. Especially right now, right? We want to try to keep cash. Is there do you guys have packages for investors that are, have 7, 8, 9, 10, 12 properties, but also aren't looking to put the whole 20 down?
So that's the tricky part in this market. I mean, there was a 15% DSCR option up until March of last year, but the second that everything started changing and rates shot up, that went away because Wall Street was convinced real estate values were overvalued.
Right.
And so that has not come back yet at this point. So on the DSCR side, and for any of your listeners that don't know what that is, DSCR stands for debt service coverage ratio. It's just a fancy acronym for does the property cash flow? And this loan program is the program that is used on the commercial side that's been adapted to residential real estate. All we're doing is looking at the cash flow analysis of the property. If the rent covers the mortgage payment, the all-in, principal, interest, taxes, and insurance, and homeowners association dues, if there are any, if it covers all of that, then it cash flows, and it's a minimum of 20% down at the moment. If it does not cash flow, let's say that number is below, so we'll go down to a 0.75, which just basically means if it's not cash flowing, then there are other options, but it's a minimum of 25% down. These are the preferred methods for investors to get to that point where the tax burden becomes too large, or they start hitting the cap, the finance property cap, depending on, and everybody's situation is a little different. And so when we go through the loan and tax planning side of this, we really sit down and do the deeper dive and give advice based off of what we're seeing from the previous year's tax return, current portfolio, and then what the forecast is for, the upcoming year or two. And, like I said, work backwards from there. But back to your original question, as far as alternatives for you to scale with limited down, all of the less than 20% down options right now are still only available through either primary residence financing or the 10 or 15% down options that all require full documentation.
Got you. And on the second home stuff, like, the second home loans, is there a distance requirement?
Yeah, it's a great question. So it's a minimum of 50 miles, and it is a hard 50. So if it's 46 miles, it's as a crow flies. So our underwriters verify it. It's actually not in the guidelines specifically, but this is a common rule. This is a rule. We verified it with Fannie Mae. That's what they want to see. And with this, so I get this question all the time. When it comes to the second home loan, it's got to be 50 miles from your primary. Also has to be 50 miles from anywhere else you own real estate currently. You can't go into a market where you already own real estate and buy a second home because you already own real estate there. So you can use this program to enter new markets. You're always going to want to use it as the first property as you buy a property in a new market. And then you can use the 15% down around it for any other properties around it. The other thing to keep in mind too is I just had this come up recently, and I've fought this a couple of times over the years. I have a client that owns a condo in Kauai and wants to buy one in Kona. It's the same MSA. Even though it's over 50 miles, it's still considered the same market, and we can't do 2 second home loans in that market. The good news is, though, is you can have multiple second homes. So it's not just one. I have a client that bought one in Lake Tahoe and bought another one out in the desert. And, recently we just had one up in Big Bear and Palm Springs. You guys know how close that is. You can do it because they're different markets over 50 miles away. You can have multiple in the same state. You can have, theoretically one per state, as long as it makes sense in theory. The problem is that you've got to fully qualify for those properties with your debt to income ratio. And we all have our cap, unless you're Bezos or somebody that, has limited money, but then you wouldn't be doing financing like this to begin with. So, that's the catch 22. And the other issue is with the second home loan, we can't use any rent, even though, you may be Airbnb-ing it that first year. We can't use any rent to offset that payment until it's on a tax return. So once you file that on a return the following year, then we can use that income to help offset that mortgage payment. But until then, it's a full hit. And the big difference between that one and the 15%, with the 15%, we've got a workaround where we can actually use the rental income during that first year to where it doesn't have that full DTI hit, while we're waiting for you to report it on your tax returns.
Jeff, are interest rates different for these, for the 10 and the 15%?
Yeah, it's a great question. So that's one of the big shifts that's occurred over the last 18 months is that, looking back, let's say over 18 months ago, my entire career, second home loan rates were only about an eighth to a quarter over primary residence financing. And it really was in that range the entire time. Investment property financing was only about 3/8 to a half a point higher than primary residence financing. The government, this second home loan specifically was originally intended for people that wanted to buy a vacation home to go visit, and long before the evolution of Airbnb. And over the last 5 or so years, the government realized that this program has turned into this hybrid quasi investment property loan. And they really wanted to slow down the usage of it because the 10 and the 15%, they're the preferred methods to scale. And they understood that. So what they did, they spent a year or two going and trying to figure out a way to rewrite the guidelines without taking away the program entirely. And then the government, in their infinite wisdom, came out with a broad brush and just made second home loan financing synonymous with investment property financing. And then they increased the rate spread. And so where going back to the eighth to a quarter over primaries for second home loans, it's now 3/4 to a full point, depending on what the market's doing. And they did the same thing with investment property financing at these lower down payment thresholds. Where they made it a little bit better is that if you're putting 25% down or more and you can qualify full doc, the pricing is actually significantly better than it is at the 20, 15, or the 10. And so this all goes back to what this administration is doing to really slow down real estate investors from buying up all the limited inventory out there by making it more expensive. So the analysis just doesn't, the math's not mathing the way it once did, and making it more difficult in the meantime to hopefully free up a little bit of inventory for some of these first-time home buyers and low to moderate income families to come in with all of this down payment assistance funding that's out there to get more people into homes. More families into homes.
And what's the difference between a 15 to 20 to 25% in rates?
I haven't looked at it this morning because it's so ugly right now that, I don't want to stress myself out, but shot in the dark, primary residences, I think are up around 7.75, 7.5 to 7.75 right now after this last week. And then second home loans, they're going to be up in the eights, probably mid eights at the moment. So it's about a 3/4 point spread, and that's been holding recently. Earlier in the year, there was up to a full point spread. And really and I don't want to get too deep in the weeds, you have a tendency to overcomplicate things sometimes, but what they did is they rolled out a 4-point hit on the second home loan too and made it very expensive on the front end. And so that's where Wall Street really stepped in and rolled out this program, a non-conventional option where we can go even higher with the rate with lower cost, but those can even go up into the 9s right now. And so depending on the market you're buying in, there's some strategies that we use. Like we've got, especially specifically with the 6% home loan, 10% down home loan, vacation home loan, like you're doing, Rafa. Remember, we're doing the 6% credit. So what we do is we come in, request or ask the seller for a 6% credit and actually build it into the purchase price. And there's different strategies depending on the market because, like out here, I always like to use Joshua Tree as one of the examples because we, have done so many of those out there over the years. In that market, you can come in and go below market and ask for a 6% credit on these because homes are sitting on the market. When you look at other markets that are more competitive, let's just say Florida, for example, it is much more challenging to get a seller credit down there because there's so many people, demand so high. And so depending on where you're buying, we may have to get a little more creative than other markets. And this is one of the workarounds that we're doing to actually help you maximize your cash on cash return, because by getting that credit from the seller, we're able to buy the rates down into the high 6s, low 7s to beat these higher rates that we're seeing right now.
Can you buy down the rates yourself more, or does it have to be a credit? What does that look like?
Yeah, I mean, on the second home loan, it's up to the max that can be charged is 3%, including the title fees. And then on the 15% down option, the max is 5%. So all-in fees can't exceed 3% on 10% down loan. So you can theoretically do a 6% buy down from the seller and then do about another, depending on the loan amount, 2.5% buy down if you want. I typically, with where we're headed with rates, we know there's a refinance market coming. I mean, it's just a matter of time. I'm recommending not buying the rate down any further than you have to, but with this strategy, at least it minimizes the amount that you have to come in with at closing, because there's going to be, once this does turn, it's probably going to turn pretty quickly, and there's going to be some refinance opportunities. So it just doesn't make a lot of sense in this high rate market to, do, too far of a buy down or spend too much money buying the rate down, because then you're just going to have to wait longer to refinance. And you look at what the actual break even point is. A lot of times when you're buying a rate down that far, you'll have like a 3-year break even, and you're losing money if you refinance or sell, during that period.
Yeah. Jeff, do you ever see, because I've worked with lenders before, and they'll automatically add a point to like everything they're doing. Is that pretty common?
Yeah. So we have no point options. There was earlier this year and even late last year, really another part of this shift was, the secondary market is convinced that there's a refinance market coming as well. You've got to think, there's a required rate of return baked into all of these loans that we're doing. And looking at it from that perspective, the servicers on the secondary market all know that these loans are going to be refinanced in a very short period of time, and they're not going to make any money in interest over the next few years. So what they're doing is actually compressing that required rate of return onto the front end. And that's why we have been seeing, across the board, most lenders have some kind of points associated with their loans. Some loans are more expensive than others. Even primary residence financing has been anywhere between 1/4 to 3/4 of a point, unless you really want to raise the rate, high. That spread is just not there. They're not paying the premium on the back end of the loan that we normally see in normal markets. The days of doing no closing cost loans, for instance, we could, turn the clock back 24 months ago, we were doing no cost loans where we could raise the rate, 1/8 or 1/4 and build in the closing costs. We'd get a spread on the back end of the loan that we could apply toward our client's closing costs. All of those options have gone away. And that's it in a nutshell right now. It's just the market. There's so much uncertainty. There's been so much volatility. Wall Street doesn't trust the Fed, and I don't think any of us do at this point. I think they're getting closer, like I said, to coming to an end with all of this, but there's a lot of misinformation. The right hand's not talking to the left, it seems like. We've got half of the Fed that's coming out saying we need to keep raising the rates another quarter, plus we've got to keep this going. The other half is saying let's slow it down, and it'll be interesting. We've got a November meeting coming up. We'll see what they do then, and I think it's going to be very telling once we get these next 2 employment readings that are coming out between now and then, what they're going to end up doing going into Q1 of next year.
Yeah, well, I can tell you that I'm over here near San Francisco, and there's layoffs happening all over the place. I was actually just reading. I was trying to pull up an article as we were talking about this. 2 tech giants lay off. Meta, the video game industry is laying people off. Cisco, which is a huge, national company, laying people off. So there's a lot of Salesforce, massive company. In fact, they have one of the taller buildings in San Francisco. Biotech firms laying off in San Francisco. So this is just one little piece of the puzzle. San Francisco is a mess right now, but yeah, there's layoffs happening all over the place, man. So that's not helping this at all either.
Well, what's been interesting, and I'm glad you brought that up. And what we've been seeing is, we've been getting these jobs numbers that have been coming out. I don't know if you guys have been watching this, but then they come back, a few weeks later and they revise it down. So we've had these huge revisions down where it's interesting, and I've got to be careful about what I say here, but they come out with these numbers that kind of fit their narrative. And then, weeks later when nobody's paying attention, they change it. And it doesn't impact the market, but we're seeing that trend. They've done it multiple times now. So it'll be interesting to see what they end up doing. And it all really just goes back to what I said earlier, where they are going to overdo this. They need to make sure that inflation has been squashed entirely before they, they'll probably pause before then, but before they actually start reversing monetary policy and lowering the Fed funds rate, because they just don't want to end up in a similar situation. Because the problem will be is that if it does start taking off again, then we're going to have inflation for years to come. This will get so ingrained in our psyche as as the population, as human beings, that, like I said, every decision we make is going to be based off of where price is going to be next year. And that is their primary goal here, is to get, squash inflation, bring it back down to somewhere around 2%. We'll see. I think that they're going to have to crush the economy to get it that low. But I think that what they'll probably end up doing is moving the goalposts a little bit and settle somewhere around 3 for the foreseeable future would be my educated guess. But, time will tell. It's going to be interesting. And it's like you said earlier, Jesse, I mean, these are unprecedented times. I mean, we never had a pandemic like this. We've never given away so much free money in such a short period of time. And it's led to all of these problems that we're experiencing now.
Yeah. And, the crazy thing too is, talking about it, we're investors now. And Rafa, you've probably seen this too. I've never seen so much money floating around for people to like invest into things and maybe I just haven't paid attention to it as much. And maybe that's the right term to use because I think my mind's shifted over the last couple of years. But man, I feel like there's just money everywhere. And there's a lot of opportunities to not only make it, but to also borrow it. I mean, Rafa's already been able to grab a ton of money for his projects he's working on. So there's definitely money out there. But again, these rates they're tough. It's hard. In fact, we were talking about on the last couple of podcasts, finding a 1% rural property right now is freaking hard to find. It's like, it's hard, man. And if somebody finds it, they talk about it on Bigger Pockets, and all of a sudden that market is like, it changes already overnight. So that's tough, man. I'm going to kind of shift this conversation to another spot. I know we're getting close to the top of the hour, but I wanted to just make sure I touch this. With the rates and you guys adjusting to everything right now, there's a lot of people that short-term and mid-term rent. Are you guys looking at only long-term values, or are you able to factor in short and mid-term rental, rates or rental rates?
Great question. Yeah. So short and mid. So we were on the leading edge of this. And so just so you understand too, when I said we do the conventional and the non-conventional, we're a direct lender. All of the loans that we do are done in-house. We make our own underwriting decisions with this, where the majority of our competitors are brokering these loans out to a few different companies. And we've established the relationships on the secondary market where we're selling these directly to a couple of pension funds, insurance company, and then we've got a couple of conduits directly to Wall Street. And we have 2 specifically that fully understand the short-term rental space and the mid-term rental space, and they love it. And they're willing to take the risk. With that being said, we can do up to 80% loan to value with the short term. We've got on the purchase, there's different ways that we calculate that income. So you can ask me questions if you want me to elaborate on this, but the short answer is that we can look at either the 1007, the rent survey that comes back from the appraiser. If it's in a short-term rental MSA, we can also use the Air DNA analysis, or if you're buying an active short-term rental, we can use the current operators analysis, the printout, Airbnb printout. And then also on refinances, we can use your current printout as well. So like on one of your midterms, Jesse, we could theoretically use your printout as the cash flow analysis, which would supersede the rent survey that comes back on the appraisal. So there's outlets for that. The rates are a little bit higher on these because of the additional risk. You're always going to get the best terms if it's cash flowing on a long-term basis, just because obviously that's the conservative approach. And worst case, if something were to happen, that's what most investors are going to default back to if, for whatever reason, the short-term, mid-term business fails.
Wouldn't you think that the rates would be lower? Because if you raise a rate, it's a higher payment, and it kind of raises the risk of it covering the cost.
It's all based off of risk from our standpoint, and the riskier the analysis or the situation, that's why credit score, loan to value, cash flow analysis, those are all risk factors. And I mean, you look at it from just about any industry on the side. Insurance is all based off of risk, and short-term rentals and mid-term rentals are inherently risky. I mean, it's a different model. It's a newer model that has, if we were having the same conversation 2.5 years ago, it was all long-term. I mean, this has really evolved over the last few years to where this has been, short-term and mid-terms have become an acceptable asset class where, it is looked at independently of, let's say long-term rentals where, it is on the long-term side, we know that tenant's going to be in there for at least 6 months to a year. We know what the set rent's going to be. We know what the fair market rent is in the area. It's much easier to calculate, and we know that that's what you're going to end up doing if something doesn't work. On the short-term side, because of that additional risk, because the fact we're having to take a printout from either AirDNA or Airbnb or Vrbo, showing what you guys are making, that increases the risk. Even though we're looking at it, let's just say the market shifts and all of a sudden, like what we saw out in Joshua Tree in a lot of markets where things, they're just not cash flowing the way that they once were at the moment because of what's occurred over the last year. That has to be baked into the interest rate calculation.
Got it.
Got you. Yeah, that makes complete sense. Real quick, because I know we're at the top of the hour right now. We were just talking about this offline. I have a property right now that I'm thinking of that I bought a year ago, and it was a total down to the studs. I didn't expect the rates to go to freaking 8%. I bought the place for $710. It's probably worth like 1.3 now after 300 grand in freaking work. Rob and I were just talking about it. It's been a year, dude.
Yeah.
So like right now, like it doesn't even make sense for me to go in and pull my cash out, like to have like a 9% rate.
Yeah.
Right. Like, so what would you say to people? And I've watched this happen to not only myself, but like a bunch of other investors are in the same spot where the only way to get their money back is selling, or, holding it longer and waiting for the rates to drop. So what do you say for people in my spot right now? What do you tell people?
There's a lot of lenders out there that are, trying to, drum up business and talk people out of their 3-4% interest rates. I'm a big believer in, if you're in a lower rate loan, keep that, because we're probably not going to see those rates again anytime soon, especially if you're in the 2s or 3s.
I'm at 6.
If we sit, 6, you're pretty, there's an argument for it, let's say, depending on what the rate would be. But I always recommend looking at any other alternatives first. If you have a primary residence with equity, the cheapest route is going to be to take out a home equity line. And I don't do standalone home equity lines, but I have friends that will do them for free. There's no cost, no appraisal. And we can do up to 80% loan to value. So if you do your calculation of, what you currently owe, just, you can factor in about 80% on that side. That would be the cheapest option. Then look at other alternatives. If you have, I'm not a big advocate of tapping into 401ks, but if you have, any savings, something along those lines to tie you over, or outside investors, partners, stuff like that may want to step in while we're waiting for rates to come down. That would be a better option than getting out of, your even 6% loan and raising that payment. And for our clients that are in the low rate loans where, you're in 2, 3, 4%, I recommend never touching those loans. Yeah. We're not going to see rates that low. I know a lot of people are waiting we're going to have much bigger problems with our economy if we end up back down around those levels. Personally, I hope we never see them again because it's created so many problems as a result. But yeah, back to what you were saying. If you're in the 6s or 7s, there could be an argument for it because it's, even if you go up to a 7.5 or an 8, how bad do you need the money? That's the bigger question. And then the other thing I will say, there are a handful of small regional banks out there and credit unions that are doing investment property home equity lines. Mm-hmm. I have one friend specifically in San Diego that's doing them. So if anybody has questions, that's part of what I've done is I built a network over the last 20 years of people, and if I can't do it, I have somebody that can, and I, refer out to people that just don't fit our niche. Same thing goes with, other programs that we really haven't touched on. We have a lot of creative financing options where we can do portfolio lending. We have clients that will do 20, 30 properties under one umbrella. We have lending options for that. Non-recourse options for our clients that have built businesses that have experience that no longer want to personally guarantee their loans. Right. We can do those. We also have options for cross-collateralization. So if you have multiple properties that have equity in them, but don't have, money for a down payment, we can cross-collateralize multiple properties in order to bridge that gap. So that's another alternative. And then I've got some great outlets for hard money. So if there's anybody has questions, on any of that, please reach out. And then any other questions on that side?
I think that's it, man. I think, well, first off, you've probably been the most in-depth. I can see why Rafa uses you as his lender now. The most in-depth conversation when it comes to lending. Like you get everything down, you understand it, you get it. So it's been a pleasure.
So, Jeff, really quick before we end this, because I don't want to end it. This is probably going to go a little bit longer than our usual episodes. Talk about a couple other strategies that other people can use or investors can use to maximize their cash flow, their cash on cash return, or even just to get into a property itself.
Okay. Yeah, that's a great question. So I talked about the 6% buy down on the second home loan. There's other strategies that we use in order for investors on investment property loans, because with the seller credit strategy, we can do up to a 9% credit on primary residences, a 6% credit on second home loans. And then on investment properties, it varies depending on the type of program. So like that 15% down option, we can only do a 2% seller credit. But there are other alternatives on the non-conventional side that range anywhere from 3 to 6%. So for instance, I mean, on the DSCR option, we have an investor that allows for a 6% credit where they will do the short-term rental analysis. We can, let's just say the rate's up in the high 8s. We can buy that rate down into like the mid 7s using that seller credit. Last I looked before this recent rate increase. So maybe a little bit different here right now, but that's one option that we're doing a lot of. And then another alternative to this is we have what's called a 2-1 buy down that's up until recently was only allowed on primaries and second homes. We can now do it on the investment property side, including on DSCRs. We have one investor that allows this, where we come in, we have the seller pay for it. And let's just say for these purposes that the note rate is 8.5%. The first year, the payment will be based off of 6.5%. The second year, the payment will be based off of 7.5%. And then the third year, it goes up to the note rate of 8.5%. And this is another strategy that we're using to help maximize our clients' cash on cash return and cash flow while we're waiting for interest rates to come down to where we can refinance. So these are a couple of the options. And then we have one other option that just rolled out here recently in the last 60 days where we can actually, on the second home loan, if you put 15% down, we can break it up into 2 loans. We can do a 70% first and a 15% second, and you avoid the mortgage insurance. The cost is a lot lower because we're keeping the first mortgage at 70 LTV. And that home equity line on the second, the 15% home equity line, has an interest-only payment. So it brings the total monthly payment down a lot lower than if you were to do a side-by-side analysis of an 85 LTV with or without mortgage insurance versus breaking it up into 2 loans and doing the combo option.
Okay, so I'm glad you brought these up. There's a lot here, because what qualifies somebody from doing ours? Like, for example, ours, we're doing the 6%, right, for my specific vacation home. Why not go with these other options? They sound better, like the 70 and the 15%.
They have lower debt to income ratio requirements and higher credit score requirements. Yours specifically made the most sense to just do the straight 6% because you're only putting 10% down. If you were putting an extra 5%, we could look at some of these other options, but I know we've talked about that offline and we were trying to keep it at the 10%.
Yeah.
They don't allow for that combo option up to 90. Max is 85% combined loan to value.
Got you. Okay, so then here's another question. Going back to for the short-term rental, the DSCR loan, you said you can get a 3% credit?
On the DSCR, up to 6.
Up to 6. Okay.
Yeah.
So explain that in a little bit more of like simpler terms. So let's say I buy a tiny home for 310.
Yep.
And we put 20K down, which is 62K, right? Yep. And what would the interest rate be? Because I put 20% down, right? So how would the interest rate look before, and how would it look after the 6%?
I would have ran some pricing this morning before this, but the last time I looked at it was last week.
Here's a hypothetical.
Yeah, hypothetical. So, I mean, we were looking at around 8.75 on one scenario, and with the buy down, we were getting into the mid 7s. And so, I mean, that's how big of a difference it can be.
Wow.
But it all goes back to ultimately what you qualify for. So we're going to look at credit score, loan to value, cash flow analysis. I mean, if we're looking at a long-term analysis, we can get the rates down into the high 7s right now without a buy down, but it needs to be, 25 to 30% down and with a longer prepayment penalty. And we haven't really touched on that yet, but that is a good rate spread for that full 6%, just as I'd say anywhere between, depending on the program and cash flow analysis and qualifying criteria, anywhere between a half and a full percentage point.
I was just going to ask, it's almost like an ARM. You're kind of talking about an ARM. It almost sounds like that.
Well, so you have the option of either a 30-year fixed or an ARM. I mean, we have a 5 and a 7 and a 10. The pricing is only marginally better with the shorter term ARMs. And, we always look at both options because it's always changing. And because there's multiple investors in this space, and they're constantly moving the goalposts on us. I mean, the guidelines change all the time. This is not like government lending where it's here are the guidelines and they're pretty static. I mean, it stays this way with, we do get changes here and there, but they're relatively infrequent in comparison to the non-conventional side where it is like hitting a moving target and they're constantly changing rates on us, changing guidelines. And it's interesting, but it has been over the last 6 months been trending in the right direction where if we were having this conversation at the beginning of the year, the max interested party concession or seller credit was 2% across the board on investments. And now that's really opened up on the non-conventional side where some investors will allow for up to 3. We have a couple that'll do up to 6. So it's the evolution of this space. And it's really the money from Wall Street that stepped in to fill the void where the government has stepped out.
Got you. Okay. So would you still recommend ARMs, or you think those are like, those are not a good move? I mean, we don't know what the rates are going to do, stuff like, I mean, how do you feel about that?
You want to tell people what an ARM is first? A lot of people out there don't know what it is.
Yeah, it's acronym stands for adjustable rate mortgage. And it just basically means that it's fixed for a certain period of time and then it goes adjustable after that. And there's different variations of it. The ARM program's got a very bad reputation prior to after the collapse, because prior to the Great Recession, we were doing 2-year fixed loans with 3-year prepayment penalties and all this crazy financing. I mean, it was just amazing some of the stuff we were doing. We were doing negams, which were negatively amortizing loans where we would give people payment options. And if they made that minimum payment, their principal balance was going up every month. And this is what we were getting. These were the loan programs that were incentivized by the secondary market. They were paying us huge amounts of money to sell these loans, and they were horrible loans. The ARMs of nowadays are nothing like the ARMs of the mid 2000s. They've been completely cleaned up. Most of them start at a 5-year fixed period. There's a 7-year and a 10-year fixed as well. They typically will only adjust every 6 months to a year afterwards. And really the benefit is that the rate is slightly lower, typically about 1/8 to 1/4 lower, which will help with your analysis, your cash flow analysis. And then the strategy always is with these is to get you out of them as soon as rates come down. So sometimes it does make sense, but with a lot of these programs, the rates have been the same recently as 30-year fixed. So we've been doing more 30 years than ARMs.
Got you. Cool. Thanks for that explanation, man. I appreciate it.
What about statement loans? Let's talk about that for a second.
Okay. Yeah, we haven't touched on that. So yeah, on the non-conventional side too, this is something we haven't touched on yet at this point. There are other alternatives. So a lot of our competitors that are in this space they'll have the DSCR, they'll have the fix and flip, that kind of stuff, but they don't have these options that I'm going to mention right now. There's a business bank statement loan for business owners that is the workaround. So one of the big benefits of being a business owner is you get to write everything off and pay nothing in taxes. The problem is that doesn't put business owners in a very good position to qualify for traditional financing. And so what Wall Street and the secondary market has come up with is a business bank statement loan where we can look at the last 12 to 24 months business or personal statements, bank statements, if the business deposits are being run through a personal account, and use that average as your income. There's going to be a factor that we have to hit because there's an expense ratio for every business. For instance, restaurants run a very high, the expenses are very high. So their expense ratio is very high that we have to hit those deposits for, versus, let's say, a realtor that's working from home, very little overhead. So it's a much lower expense factor. But with that program, we are looking just at the cash flow analysis of the business over that average period, either a year or two, and using that as the qualified income to qualify for the loan. And we're not having to look at the tax returns. And that's the big benefit. We can still go up to 90% loan to value on primaries. The rates are still pretty good on them. And it's the workaround for business owners that have trouble qualifying for traditional financing.
I'm glad you brought that up because that's how I got my primary home. And it was a bank statement loan, 10% down. And it's funny because at that time it was higher, high interest rates, 4.75.
Oh my gosh.
When it was going for 2.5 or whatever.
Good old days, yeah.
And now I'm like, hell yeah, thank God, So anyway, aside from this, and I'm glad I have one last question, and then we can close it out with some of these other questions that we ask everybody. what do you think about 30-year fixed rates and 40-year fixed rates? That's something we haven't talked about at all.
Yeah, the 40-year, it's coming back. The rate's higher on it, and the payment's only a little bit lower typically when you do a side-by-side. I mean, it's not, so they've rolled out a 40-year fix with a 10-year interest only. There's no benefit to it because it's an interest only payment. It's the same on, let's say a 30-year fix with a 10-year. It's just, it's amortized. Once you get out of the 10-year period, it turns into a 30-year fixed. If you look at a 40-year principal and interest versus a 30, yeah, the payment's going to be lower, the rate's higher. And it just, I don't know. They haven't really made a huge comeback yet. They were, before the collapse, we were doing a lot of them because of the, that difference in the payment. But, it's been varying, depending on what the market's been willing to buy. And honestly, I haven't been doing any of them. I mean, I saw them come back. The rates were so much higher on them that we just, we really haven't implemented them on our side. But one of the programs too, on that note, there's one other non-conventional option, that we have not discussed, which is the asset qualifier. This option is for people that are higher net worth, that don't have documentable income. I mean, you don't have to be, extremely high net worth, but we can use any assets that you have, liquid assets. So checking, savings, these type of investment accounts. We can use retirement accounts, even if you're not at retirement age. And there's a calculation to where we can use that as income. And so this is a workaround for our clients that either have no documentable income or limited documentable income and their debt to income ratio is too high. We'll take a look at whatever their current income is, and then we'll do the calculation based off of their assets to supplement it. And a lot of times we can bridge the gap with this.
Got it. Sweet, man. Well, Jeff, this has been an awesome conversation, dude. I mean, just the amount of knowledge and insights that you brought is going to help a lot of people. So I appreciate you coming on. I want to ask you, I want to ask you the same question we ask all of our guests here when they come on, being that this is the Big Break Show. I want to know, what do you have a big break, a moment in your life that was like, that changed the trajectory of where you're at now compared to what you were before?
Yeah, I mean, absolutely. I mean, there's been a couple. I'll give you the short version, and it's the first time I've told these stories on a podcast. The first one, so you go back about 10 years ago now, I actually opened a branch with one of my friends that I started in the industry with the goal of starting our own mortgage company. And I took on too much too fast, spread myself way too thin, and fell flat on my face and found myself doing a lot of things that were just not, congruent with my personality. I mean, it's just, I like freedom. I'm after freedom of time. I don't want to be trapped to a desk all day. And so that was a huge learning experience for me that ultimately led to what I'm doing now, which sent me more toward working with real estate investors. I ended up, long story short, my first investor group, the first investor group that bought out in Joshua Tree, bought out in about, I think it was late 2016. And I have been kicking myself ever since for not following their lead and buying up everything I could back then, seeing what's happened over the last few years. But that led me to the tiny home builder out in Joshua Tree, which ultimately I became his preferred lender. Then I ended up, he introduced me to Tony and Sarah Robinson when they were having lender troubles and they got their start in 2020. So that's what led ultimately to me knowing you guys and meeting you guys. And then as far as trajectory recently, so this is the very first time I'm going to tell this story. So when Tony and Sarah had me come do a presentation right when we were coming out of COVID and we were still, everybody was wearing masks and it was out in Joshua Tree, started there. It was the first time getting up in front of a group in a while. And then they had me do another one, when they were doing their ride-alongs. And then they invited me to speak at their short-term rental summit. The first one in Newport, where I think, Rafa, you spoke there, and I think it's where we originally met. So at that point, we had just fulfilled a, let's call it 15-year dream of buying another house in Laguna for my brother-in-law and sister-in-law. We closed March of 2022. And right before everything changed, we spent a year working on that place, finally got that finished. I was stretching myself too thin again. I ended up breaking 2 ribs 2 weeks to the day from that presentation in Newport. And I had every excuse in the world not to get up there and actually do that presentation. It was the first broken bones I've ever had in my life. It forced me to slow down, get focused. I mean, I sat there on my couch that's behind me, watching TED Talks, figuring out, okay, how can I connect these dots to make this presentation as effective as possible and provide as much value as possible. And I got up there. I mean, I don't even remember being up there, to be quite honest. I mean, it was kind of a blur. I was on so much freaking Advil. It was a long couple of days. But that ultimately led to me meeting so many people, and that was an absolute game changer for me. And I have built this into my presentation of, success is and always has been on the other side of our comfort zone. And I've really went all in on the idea of just pushing myself out of my comfort zone as often as possible. Like if it scares me, it's probably a good thing. And I've really become a big believer in, where there's a will, I mean, there's always a way.
I love that, man.
Yeah. That's awesome.
It's funny, really quick before Jesse jumps into the second question, how you're talking about not getting into Joshua Tree back in 16 and 17. Dude, these tiny houses with Neil, I don't know if he was the one selling it, but I saw it for $80K and I passed on it. I passed on it. I was like, no, that thing's not going to make us any money. I'm not buying that. Oh, now I'm like, idiot.
Yeah.
But anyway.
I know. Missed opportunities. The important part is not to dwell on them and just keep looking forward for the next ones.
Yeah.
Yep. Yeah, I hear you. So, Jeff, we got another question that we usually ask. An actionable step that somebody could take today after listening to this episode, what would that step be, or that action item be?
Honestly, looking back, I mean, just getting out there, meeting people, going to events, I mean, that has been so huge for me. I mean, we're in an era right now where, I mean, you guys know everything's on social media. It's so hard to do face-to-face nowadays with Zoom and everything else. Just getting out and going to these meetups has been absolutely, critical in my growth, which has led to so many connections, so many relationships. And I think the biggest thing looking back that was, that I could pass along to anybody that's listening to this is just don't stop. I mean, the problem is that most people, you look at the majority of the population, they get 95% of the way there and they decide, oh, it's not working, I'm going to move on to the next thing. They don't stay focused and committed to one thing long enough to where they create enough momentum and get that snowball effect to occur, to where it just starts, and all of a sudden it just starts running on its own. And that, I think, would be the biggest takeaway. It's just, if you're drawn to something, whether it's real estate investing or not, whatever that is, if you enjoy it, it's going to bring you happiness in life, go after it and don't stop. Don't listen to the negativity and all the crap that's going on in the media, YouTube, and from your inner circle. I mean, there's a lot of people, there's been so much resistance that I've experienced over the years. Everything that we've accomplished and tried to do, there are so many more naysayers out there than there are cheerleaders. Listen to the cheerleaders, ignore the naysayers, and surround yourself with the right people. And I mean, the sky is definitely not the limit.
Dude, I love that you said that, because I was just talking about that. And even on the last episode, I don't know, Jesse, where I was like, it's always about the snowball effect. Put your head down, get to work, do what you love, and eventually you're going to look up and you're going to go, what the hell just happened, right? And things are just going to start coming in after the other. I mean, to give you the example, right? Like when I tried to buy the ranch, we couldn't make it work, right? And I was like, no, this project is exciting. I got to get this thing. And look what happened. I found a way to make it work. And I was like, yeah, and it was
genius too. I mean, I love the structure on that one. I mean, I don't know, you should do a whole episode on that one of these days, but yeah, that was incredible.
I'm going to make a YouTube video on it. Actually, I had Danny go down there and record footage because I'm going to talk about the entire thing. So I'm excited about that one.
That's great. Yeah.
But all right. Thank you, man. So Jeff, last question. What's the best advice you've ever received?
Since we're talking about real estate investing, real estate is a long game. This is not a get rich quick scheme. And if you treat it as such, you're going to get burned. And you're going to end up losing money in the long run. But as long as you don't overextend yourself and you stay committed to it, I mean, it's incredible what real estate can do. And there's a reason why it is the best performing asset class in history.
Love it.
Totally agree. Well, there it is, folks. Jeff said it all. All the mortgage details, Bluprint Home Loans, doing Rafa stuff, doing the Robinson stuff. Shit, I might have to reach out to you now, Jeff. dropping all this knowledge today. You know what? I realize why the Robinsons have you come up and speak, man. You are an eloquent speaker. You come across very well, and you're knowledgeable as hell. So you're attracting folks. You're not chasing people anymore, and I see that. So kudos to you, man. Where can
Thank
folks
you.
find you at?
Appreciate it, Jesse. Or my website is bpinvestorteam.com for blueprintinvestorteam.com. And then I am on Instagram. It's the only place that I really am on social media. And it's Jeff.themortgageexpert. There's another, come to find out recently, there's another Jeff the Mortgage Expert with underscores. That's not me. So it's Jeff.themortgageexpert.
That's funny.
And then we are 2024 plan, working on some YouTube channel and really trying to get the social media dialed in. So we got some good things coming, but it's still a little ways out.
Yeah. I got to tell you, man, you definitely should. You know a lot that could help a lot of people. I mean, if I've learned one thing and any takeaway from this show is like, have the right people in your team. And I'm so glad that I'm working with you because like, dude, you make my life easier, man. No joke. Like I just ask you random questions and you'll call me and you'll explain everything in detail. And I'm like, oh shit. Okay, cool. I got that. You know what I mean? So I appreciate that a lot. And I appreciate you coming on the show, man. This was awesome.
Yeah. I appreciate the invite. It's been great. A lot of fun. I know, let me wrap this up. So anything else?
I think that's it, man.
Thanks, buddy.
You for being
All
here.
right, guys. Thanks again.
Thanks, Jeff.